When I left my desk at Bloomberg a few minutes ago, I checked. The last thing I did was to check where December is priced, the possibility of a December hike. 72% was the number that it kicked out for me, the work function, as they call it. Are you comfortable with 72%, or do you think it's time for maybe the Fed to pause?
Well, we just submitted a summary of economic projections for the last FOMC, and I believe the median dot was 4 rate hikes this year, so that would indicate a high likelihood of one more this year. I'm quite comfortable with the expected path embedded in the median of the SEPs. I think that my own take on a neutral longer run funds rate is 2.75%. So I think getting policy up to a slightly restrictive setting, 3.25% would be consistent with the strong economy and good inflation that we're looking at.
So I'm just nailing down your dot. Your dot is, so you're still, you like the idea of a December hike? I'm
quite comfortable with that, yes.
Okay. What do you make of...
according to the rules, we're not supposed to identify which dot is ours.
I fully appreciate that. I'm just sometimes nice to play with the rules. Just in terms of the data, if I take a look at the inflation data, it's a slight softening of late. Does that in any way concern you?
I think the inflation data picked up in a pretty nice fashion. We're at 2%, just a touch under perhaps given monthly data movements, but it's improved quite significantly in the last couple of years. I had been saying for quite some time that we needed to provide enough accommodation so that we got to 2%. We have a 2% symmetric inflation objective, so it's completely fine to go above 2% for some time. In fact, we ought to average 2, be above 2 half the time perhaps. So getting inflation up to 2 is really quite an accomplishment. I would say with the unemployment rate at 3.9%, I think we're well positioned to continue with inflation at our objective, perhaps just a little bit above.
I'm going to get you to speculate here for a moment. What was your read on Amazon's decision to raise its wages yesterday? It's picked them up to around 15. It was interesting news from an Amazon point of view. Is it an interesting piece of news from a Chicago Fed point of view, from an FOMC point of view? Kind of just speculate for a moment. What do you think the reasoning behind all of this is?
Well, I think this continues a trend where firms, corporations are sort of announcing modest adjustments to the lowest entry wage that they pay their workers. On average, their wages would be higher than that because they have a variety of skilled workers in their firms. And so wage growth has been increasing somewhat over the last year or two, and we're at about 3% according to ECI right now. And during the mid-2000s, we were at 3 to 4%. We had slightly higher productivity. We have lower productivity now, and so that 3% probably seems reasonable. I'd like to see it stronger, continue to add to income growth, consumption demand, and keep the economy growing in a strong fashion as it is right now.
Chairman Powell's kind of talked about the Phillips curve being incredibly flat. Are we sort of getting to the other end of the flatness in terms of where we are in this process?
Well, the relationship between inflation and resource slack is quite flat, and so even though the unemployment rate has moved down to 3.9%, my own assessment of a sustainable rate is 4.3. We're only a little bit below that, so even with a steeper Phillips curve, I wouldn't be expecting much of an increase in inflation, but it's even flatter than that. So I don't think that's going to put a lot of pressure on inflation. My own forecast sees unemployment falling to a range of 3.5% before it begins to pick up a little bit more towards the sustainable rate. I think inflation could easily be 2.1, 2.2%. It's the fact that inflation expectations are anchored so well, perhaps a little too well. I think they could be just a little higher and be better consistent with our symmetry around 2%. But the inflation outlook really seems quite good now.
I listened to Jay Powell in Boston last night. Almost like the U.S. economy sounds amazing, almost too good to be true. Is that the case?
I think the fundamentals are very strong. We've had strong labor markets. I've already mentioned the unemployment rate. We've seen payroll employment growth month after month average around the 200,000 range. That is a strikingly large number. If we were only replacing incoming workers into the workforce, we'd expect something closer to 60 to 100,000 per month. We're at a very mature stage of the expansion. It's been running for quite some time, continues to be very strong, and we're adding 200,000. So something very good is happening with the labor market. More people are finding work, increasing their attachment to the workforce, and that pays stronger dividends going forward.
Kind of picking up on the Goldilocks kind of theme, asset prices. Let's talk a little bit about asset prices. The last two recessions, I guess you could fairly say, were caused by asset price bubbles. Are there asset prices out there that you look at and think things are getting a little toppy now, and that worries me? I think the Dow hit a fresh intraday record again yesterday.
So certainly we've seen quite a lot of change in public policy since the most recent presidential election. President Trump came in, and there's been quite a lot of deregulation, which is beneficial for businesses, and so they've been quite optimistic, and their investment has picked up somewhat. I think that this supports naturally stronger asset valuations, and we've certainly seen that. It's interesting you point out the last two recessions, which were preceded by high valuation peaks, and I would say that they were each different, because in the 2000 stock market peak, when there was a decline from the tech bubble, there wasn't a lot of leverage embedded in the economy, and so we had a relatively mild but prolonged recession. The 2007-2008 was a completely different story because there was so much leverage embedded in the system. As we look at the financial stability implications for the economy, as we do every quarter at the FOMC, it looks like leverage is not really that big of a concern at the moment. If anything, I would say that risks are moderate, and these are valuations that could well stay around. Goldilocks
alive and well. Can I ask you whether you worry about Italy? You're on this side of the Atlantic. It's part and parcel of the narrative over here that we have concerns about what is happening. And you clearly, when you all sit down, talk about kind of what is happening globally. You have a domestic focus, but clearly the international situation does impact that. How far up the kind of list of concerns right now does the international story sort of sit, and kind of what part of that is Italy? If there was to be a problem in Italy, would it, for instance, delay the ECB exiting extraordinary measures? Could that have an impact on euro-dollar, for instance, which is trading, I don't know, circa 115, 116 right now?
Well, as U.S. monetary policymaker, as a participant at the FOMC, we're always looking at the international environment. Obviously, the situation in Europe, the situation in the UK is of great interest, and so Italy, Greece, and Germany, every every aspect of the European Union economy is very interesting. I think that the larger story is that growth around the world is pretty good. The European pickup over the last few years on the strength of good accommodative policy by the ECB, and the UK economy seems to be going quite strongly too. Now, of course, every country has their own challenges. I come from the state of Illinois, and we have our own pension challenges, and how that gets dealt with within the individual states or countries and as part of the European Union is a little bit more of a difficulty that I know how to appreciate from the standpoint of the U.S., but it looks like financial markets are handling this.
With the greatest respect, I can't see Illinois leaving the United States anytime soon,
yes,
or the dollar sort of anytime soon. You could argue that Italy at least has that potential, not to leave the United States, to leave the Eurozone.
Well, I do know more about Illinois, and I agree with your assessment. I don't really understand the European Union so well, so I'll have to leave it to you. But,
you talk about the effect of Brexit. What is your assessment of the effects that could potentially, if we were to see a hard Brexit? Just out of curiosity, what do you think that could deliver for the UK economy? And again, how does that factor back into your thinking?
Well, it's very difficult to say. I think that looking at the state of where the discussion is, it seems well poised so that there could be an agreement. Maybe things go well. Certainly the economy in the UK seems like it's quite strong. There's a lot of building and I've seen the forecasts in the inflation environment. So it looks pretty good. Now in the U.S., we, have had trade discussions and renegotiation of NAFTA, and it's a very difficult thing to watch. It's not what I like to do, but the outcomes seem to have been pretty agreeable. So perhaps in the case of Brexit and the EU, it'll work out just as well.
You've read my mind, providing the link between Brexit, trade, and the United States. Let me wrap up a conversation about how the trade policy is emerging in the United States. We've just seen a NAFTA 2.0 USMCA coming in and replacing it. The President spoke about that a couple of days ago. What is your assessment of the economic impact that sort of evolution will have? Do you see it as being a revolution, an evolution? What kind of impact do you think that will have on the United States economy? It's closer to sort of Illinois than it is to Italy.
Well, it's sort of late-breaking news, and I haven't had a chance to study it very carefully. According to the news accounts I've read, it looks as if many of the TPP elements were rolled into resolving a couple of other issues, and so I think that the auto import situation, there's some content adjustment there, but it doesn't look like that's going to be a tremendous challenge. I think on balance, it's going to continue to be quite positive for all three countries, and businesses that have arranged their supply chains, crossing the border regularly. It was really a big risk if that was to be altered in a way that they had to move their operations. So I think that relief is welcome.
So you don't see it having a significant economic impact?
It continues the positive benefits of what a free trade agreement means for the larger area, and to the extent that could be extended towards other countries and allies that could have been envisioned with TPP, that would be a benefit.
China, obviously, then is the next question. What is your assessment of the economic impact that China and the trade war, I think we can now call it that, with China is having? It looks like it's starting to show up in some of the data. Some of the data are beginning to show some effect of that coming through. Do you expect the amplitude to increase, the effect to increase? And how do you ultimately see this being resolved in terms of the way you're planning and modeling?
So the tariff issues are really quite complicated. As you talk to businesses, you can easily imagine that individual businesses are affected in a strong way. I mean, if you're using steel as an important part of your production process, steel prices have gone up dramatically, and so I've talked to many people who've been affected that way. But in terms of its overall effect on the U.S. economy, there would be, if it were permanent, a rearrangement of activities that would sort of reduce the overall effect on growth per se. There would be a lot of losers, there'd be some winners, but growth itself would probably be diminished only a few tenths of a percentage point each year for some period of time. And so it's always difficult to get a handle on that. It affects a number of parties in a big way, but economy-wide, it's not nearly as large as that. Now, China is a very interesting and complicated situation. I can't claim that I understand it that well, because I can understand the trade relationships that we have in business supply chains that have been put in place, but the issue of how you deal with intellectual property protection is a big one. In fact, it's so big that I often just kind of go, that's not what I know how to think about and offer useful advice. But a big part of the negotiation seems to be aimed at getting the attention of each party to address that in a more productive way. Typical world trade negotiations usually drag on for years and years and years, and the current administration approach is geared towards something happening much more quickly than that. And given that the NAFTA renegotiation has taken place in the time frame that it has, well, maybe something will work out.
Maybe something will work out. Maybe something won't work out. Just to come back to the sort of the economics of it, you talked about the impact on growth being a few tenths. There'll be a process of reorganization, the net result.
Quite substantial, potentially.
Yeah.
Yes.
Yeah. The inflationary impact of that is?
Probably modest. It usually would find its way into relative price changes, and relative price changes by themselves are not inflationary unless they're accommodated in an unproductive way by the central bank. And so I think we could take that into account and focus on our inflation objective over the medium horizon, and it would be fine.